Now we've all heard about moving average trading strategies, haven't we? There are countless articles, videos, and courses online, each promising the next big thing to make you rich overnight. But here's the hard truth. The vast majority of these strategies, as high as 99%, result in losing money. Magic Indicator Strategies is here to provide solutions. In this short video, we will teach you the best moving average trading strategy you won't find anywhere else on YouTube. This strategy uses a combination of two moving averages, a higher high, lower low indicator, and stochastic RSI to predict market directions and generate trading signals. We will show you how to use these advanced indicators to find profitable trade opportunities. The strategy makes significant profits on cryptocurrencies, stocks, and high-volume forex pairs. It is proven to work in the long run with a success ratio of between 70 and 80%, which is very impressive. You will gain an advantage by using these indicators, regardless of whether you are an experienced trader or just starting out on your trading journey. If you're looking to take your trading skills even further, we highly recommend the TraderEdge app. Thousands of traders around the world use TraderEdge to gain an edge over their competition. User-friendly trading strategy backtester, profit and loss calendar, most effective indicators and strategies, all in one place. If you sign up for TraderEdge today, you'll get a backtesting course and a high win rate strategy builder course for free. Both courses are valued at over $300. This is an exclusive offer that won't last, so don't wait to take advantage of this great opportunity. Sign up for TraderEdge's 7-day free trial now and get started on the path to success. Let's get back to our trading strategy. We will start with building the setup step by step. As we add the indicators to the chart, we'll explain how they function and why we use them in the first place. Once the setup is complete, we'll explain the exact entry and exit rules, as well as the money management aspect of this trading strategy. So, let's open the Indicators menu, and in the Search tab type 10 in 1 different moving averages. The indicator we need was published by Hyman Shu. The 10 in 1 different moving averages indicator is an advanced tool that allows traders to view and compare up to 10 different types of moving averages on a single chart. This can provide a more comprehensive view of market trends and potential reversal points. The indicator allows you to choose from a wide range of moving averages. This includes a simple moving average, exponential moving average, weighted moving average, and more. Each moving average can be customized based on the look-back period that you specify. For our trading strategies, we will use 2 moving averages, the 200 period and 50 period EMA. We will also change the moving average colors and thickness. The indicator is applicable across all time frames, making it suitable for both short-term and long-term trading strategies. The reason we have 2 EMAs on the chart is to determine the market's trend and the key levels of support and resistance. The 200 period EMA serves as a trend filter. Depending on the position of the price relative to the 200 EMA, we can determine whether the market is trending upwards or downwards. This is very helpful as we don't want to trade against the prevailing sentiment. The 50 period EMA is used for finding key levels of support in an uptrend and key levels of resistance in a downtrend. When price gets rejected off these levels, the probability of a trend continuation is higher than usual. Just take a look at the following example. Here the price dropped below both moving averages. The 50 EMA crossed the 200 EMA to the downside. After a strong sell-off, the bulls started to jump in and purchase the stock. Some of them managed to make a small profit from this correction. However, since the market is heavily trending downwards, opening a buy trade at this time is very risky. Trading is all about minimizing risk and maximizing reward. So a smart way to enter the market would be at the 50 EMA pullback. If we open a short position here, we A. Sell the stock at a better price. B. Maximize our chances of the price moving in our direction. On the other hand, when the market is trending upwards, it is in our best interest to wait for a 50 EMA pullback and buy the stock at a cheaper price. However, there are some issues with such a strategy. First, we don't exactly know when to buy and sell. This can be quite confusing, especially for beginner traders. Second, this trading strategy can produce quite a few false signals in a range market. This is because we only use one price action technique, which is a pullback to the EMA. But don't worry, the next 2 indicators will solve these problems. Open the indicators again and search for the higher high lower low strategy by Lonesome the Blue. Add this script to the chart. For the next tool, add stochastic RSI. Next, open the higher high lower low strategy settings and make some adjustments. Disable the support and resistance in the indicator's inputs. Change the bar colors to red and green for better visuals. The stochastic RSI settings will remain unchanged. The higher high lower low indicator is a tool used in technical analysis that helps traders identify potential upward and downward trends in a market. It is based on the simple principle of market movements. An upward trend is characterized by prices that form a series of higher highs and higher lows, while a downward trend is identified by lower highs and lower lows. In an uptrend, the price will reach new highs that are higher than the previous highs, and the lows will also be higher than the previous lows. This indicates that buyers are pushing the price up, and even the lowest price during a period is higher than the previous periods, indicating strong buying pressure. Conversely, in a downtrend, the price will make new lows that are lower than the previous lows, and the highs will be lower than the previous highs. This suggests that sellers are driving the price down, and even the highest price during a period is lower than previous periods, indicating strong selling pressure. If the pattern of HH and HL or LH and LL is broken, it may signal a potential trend reversal. For example, if a price in an uptrend fails to make a new higher high and instead makes a lower high, this could be an early signal of a potential downtrend. Our strategy will be to use the 50 EMA pullback with higher high lower low to find better trade entries. We'll be looking for a high probability pattern in price action that constantly repeats itself. The pattern is very simple. In an uptrend, before price pulls back to the 50 EMA, the market needs to form at least one higher high and one higher low. During the pullback, the market must not break below the high low. This is very important. Final trade confirmation will be based on stochastic RSI. First, the stochastic must become oversold, which means both lines must cross the 20 level to the downside. Afterward, the blue line must cross above the orange line. In terms of risk-reward ratio, use 1:2. Place the stop loss above the 50 EMA. If the pattern was broken before a price pullback to the 50 EMA, do not open a position. Here's an example of the invalid entry. The market structure is broken here, so a trade cannot be taken. Let's take a look at one more example of a long entry. Here the market is in a clear uptrend. We can tell this by the price position relative to EMAs. A 50 EMA is higher than a 200 EMA. The market structure signals a strong bullish trend as price makes new higher highs and higher lows. Price finds support at the 50 EMA and the stochastic becomes oversold. To stay safe, it's important that the price does not close below the 50 EMA during a pullback. Wait for a bullish cross on the stochastic RSI if the conditions are met. Open a long trade and set your target. Here's an example of a short trade. First of all, determine the long-term trend. We can do that by looking at the price position against the moving averages. The 50 EMA must be below the 200 EMA. Once the trend has been identified, look for a 1-2-3 pattern where price makes at least one lower low and two lower highs. The last lower high must be formed at the 50 EMA pullback. During the pullback, the stochastic RSI must become overbought and then issue a final confirmation, a bearish cross. Open a short trade at the close of the price bar and target 2 times the risk. Traders, if you enjoyed today's advanced moving average trading strategy, leave a like on this video. By the way, if you haven't watched our video about artificial intelligence moving average that's 10 times better than EMA, check it out. It's this one right here.